let's review the Excel spreadsheet that implements the excess return model. In order to do this, we need to provide 4 inputs into the model. We need the length of the excess returns, the cost of equity, the return on equity, and the dividend payout. After you pull up this spreadsheet, as I've done here, you want to put the ticker of the company that you're analyzing in cell B1. I want to demonstrate this with Everest Regroup, and the symbol is RE. Sometimes you have to go into the Capital IQ Excel plugin and ask it to refresh. You can do it over here and just ask it to refresh the entire workbook. But I've already downloaded the data from Capital IQ. The second thing you want to put in is into cell B2, and that's the length of the excess returns. This is the number of years in which you expect the return on equity to exceed the cost of equity. In other words, you expect the company to generate residual income or excess equity returns over a 2-year period in this case. This is very tough to analyze. Ultimately, competition is expected to set in, and you would expect the return on equity to go back to the cost of equity. I've highlighted the cells that you need to pay particular attention to. These are the cells that are going to be unique to the company you analyze, or whether you're going to have to make a particular choice about which number to use. After you put in the ticker symbol, you can see that the Excel spreadsheet is going to go out to Capital IQ and download the company name as well as the primary industry that it's in. The next thing that you need to input is going to be the cost of equity, and that's in row C. There's a comment here about one approach to doing this, and certainly not the only approach. There are lots of approaches to use, but you can go to Aswath Damodaran's website and you'll be able to get the cost of capital by industry sector, and that's what I've done in this particular case. So let's go to the website and take a look. If you Google Damodaran, you'll find his website at the NYU page. After you go to that, you can click on Updated Data right here. Scroll down to find the cost of capital by industry sector and select the US. After you do that, it's going to download an Excel spreadsheet. This spreadsheet needs some inputs as well. You want to put in the long-term treasury bond rate. That's easily found by going to Google. If you go to the Google Finance website, you can scroll down and you see the bond yields are down here on the lower right-hand column. You have to make a choice which bond yield you're going to use. Right now, interest rates are incredibly low, so I would actually pick the 10-year Treasury bill rate. The reason why is because I don't think that the short-term rate, being almost zero, fairly represents the risk-free rate. The long-term rate, the 30-year rate, may be a better choice, but right now, given our current situation, I would choose the 10-year rate. So from Google Finance, the 10-year Treasury bill rate is 2.55%. I put that in cell D5. You'll want to look at the equity risk premium as well, and you can go back to Damodaran's website to take a look at that as well. So we'll just type in Damodaran. He's got the implied equity risk premium at being 5.38%, so we can put that into the Excel spreadsheet. And I put it into cell D6. Then it's going to do a calculation, and you can find the industry that you're looking at. For the property and casualty insurance companies, they have a cost of equity of 6.66%, and you can see that's in column D right here, the cost of equity. And we can go back to the Excel spreadsheet for the excess returns model and put that into here. Again, this isn't the only approach that you can use to come up with the cost of equity, but this is certainly one viable approach. The next input that you need to provide is the return on equity, and this is the expected return on equity going forward. We have a cell right here that will download the return on equity for the last 12 months straight from Capital IQ. And for Everest Re, this return on equity turns out to be 16.83%. But is this the return on equity that we can expect going forward? This is a very tough question to answer. One way that I look at it is by looking at the historical ROE. And in rows 26 and 27, you'll need to fill these in. You'll need to fill in the years up here. I recommend the last 5 years. And also fill in what the return on equity was for these last 5 years. You can get this off of Capital IQ. So let's take a look at the website. And actually, as it says here, you can get this under the ratios tab in Capital IQ. So let's pull that up really quick. So this is the ratios tab, and you can click on this, click on ratios on the left-hand column, and it will pull up these ratios. Let me make this a little bigger. It's got return on equity right here for the last 5 years, so you can see it, we've got it for 2009, 2010, 2011, 2012, and 2013. So take those numbers, put them into the Excel spreadsheet, and you can see that here they are right here. We've got a formula right here that's going to take the average of these. So this averages the cells B27 through F27. The average ROE for the past 5 years is 10.86% compared to the last 12 months of almost 17%. Is it 11%? Is it 17%? This is a question where you have to analyze the company, analyze the competition, and figure out where this industry is going to figure out what's going forward. If you prefer to use the historical ROE as opposed to the ROE over the last 12 months, you need to put that number in here. And you can see that if I decide to use 10.86%, it's going to choose that in cell B31 and use that in the spreadsheet. I'm going to assume that the last 12 months ROE is going to be the one that's going to we expect going forward, so I'll leave the cell B29 blank. Next, you need to make a decision about the dividend payout ratio, again, going forward. In cell B37, it's going to download the most recent fiscal year's dividend payout ratio. For Everest Re, this was 10.83%. Again, you need to make a choice between the most recent one or an historical one or another number. I like to take a look at the most recent fiscal years, but also take a look at what it was over the past 5 years to see whether the most recent fiscal years is reflective of what they've done in the past. You need to download the data in rows 33 through 34. And again, you can go to Capital IQ, as it says right here, go to the income statement part of this. And the way that you can go to the income statement part of this is pull up your company, click on income statement over here to the left, and scroll down. You'll be able to find the dividend payout ratio right here. So you can see it was 14.5%, 17.8%. It was not meaningful in this year where EPS was negative, 12.1%, and 8.5%. I took all these numbers, put them in to Excel. Again, you're going to have to do this yourself. And I took the average of it. The average over the past 5 years is 13.23%, which is not too far off for what it was for the last fiscal year. So I'm just going to leave it at the last fiscal year, assuming they're going to pay out about 11% of their earnings per share. We have the 4 inputs into place. Now let's see how the spreadsheet is going to calculate the excess returns for future periods. In column C, it's going to do the next fiscal year. How is it going to do that? Well, in row 15, we've got the net income. I'm going to trace the precedence, and what you can see is it's taking the future ROE in cell B31, or actually, yes, B31, and multiplying it times the beginning book value of equity, which is in cell C22, and it's coming up with a net income projected for the next fiscal year of 1,232. Where is it getting this 7,323, the beginning book value of equity? If you look at the balance sheet on Capital IQ, you can see that it's right here. This is the total common equity of 7,322.9. And the Excel spreadsheet is going right out The Excel spreadsheet is going right out to capitaliq.com and downloading this number for you. So it makes it a lot easier to do than actually typing in these numbers yourself. So I'm getting rid of the arrows. We've got the net income. It's listing the equity charge here, and that's coming from cell C24. Let's see what cell C24 is. Again, that's the equity cost right here. The way that it's getting that is it's multiplying the beginning book value of equity times the cost of equity, and that's your equity charge. You've got your excess equity return here. This company is doing great. The net income that we're projecting for the next fiscal year far exceeds the cost of equity capital. So they've got excess equity return or residual income. We need to figure out the stock price by taking the book value and adding to that the sum of the present values of the residual incomes. That means we have to compute the present value. We're going to compute the present value using the cost of equity, and here's the present value of the equity excess return right here. We're taking this excess equity return, discounting it using this discount rate, and we've got the present value here. Once you understand this basic setup, you'll understand how we do it for fiscal year +2. We're going to take the net income by taking that future ROE, multiplying it times the beginning book value of equity. How do we get this beginning book value of equity? We're getting the beginning book value of equity by taking the retained earnings from fiscal year +1, which is in cell C44, and adding that to the beginning book value of equity, which is in C22. So you can see that we've got this right here. So we have to go back to this retained earnings formula that we're using. These are the basic formulas that we're using in the spreadsheet. Net income equals the beginning book value of equity times ROE, which I just showed you. The retained earnings is going to be equal to the net income minus the dividends paid, and the ending book value of equity is going to be the beginning book value of equity plus the retained earnings. So to compute the excess returns for fiscal year +2, we need to take the net income for fiscal year +1, our estimated dividend payout ratio to figure out the dividends that are going to be paid, and basically what we're assuming is the company is going to do one of two things with their money. They're going to earn this in net income, they're going to pay out this in dividends, and they're going to reinvest the rest of it back into the company. And they'll earn the return on equity associated with that to hopefully generate additional excess returns. So for fiscal year +2, we're going to come up with the net income, which is going to be that beginning book value of equity times the future ROE that we're assuming. We'll have a cost of equity based on, we're going to have an equity charge based on the cost of equity that we're assuming. In this case, it's going to be 6.66%. Again, they're going to have a excess equity return or residual income of 857. It's going to calculate the present value of this. It's going to discount it back over 2 years, and the present value of the residual income at the end of year 2 is going to be 752. This is accumulating the present values of the equity excess returns. Now note that we assume that the length of the excess return period was only going to be 2 years here. You can of course assume something different, and what this spreadsheet is going to do is it's going to calculate it out for a lot of fiscal years, but it's going to ignore it. When you take a look at the spreadsheet, you can see that it's got lots of fiscal years in here. In fact, it goes out to fiscal year 20 years out. The spreadsheet is going to ignore part of this data based on what you put into cell B2, and that's the length of the excess returns. So I'm asking the spreadsheet to assume that it's only going to have excess returns over these 2 fiscal years. It calculates it for additional fiscal years, as you can see here that I've highlighted, but it's going to ignore that in computing the target price. How is it going to ignore that? Well, down here, it's got the data that it's using to compute the target price. And remember that the value of the equity, or the target price, is going to be equal to the book value plus the sum of the present values of the residual incomes. And that's what we have right here in the spreadsheet. We've got the book value right here. We've got the present value of the equity excess returns. It gives you the total value of overall equity, and it divides by the number of shares outstanding, which it's downloading from Capital IQ, to come up with a target price, which is in cell B5. The intrinsic value of this company, according to our model, is $190. The current stock price is $156. This is basically undervalued by about 18%. The way that it is, the way that this is taking into account the length of the excess returns in B2 is in this cell right here. In cell B47, it's getting you the sum of the present values of the excess returns by using an H lookup. So what it's doing is it's taking this length and it's doing a horizontal lookup on this data by finding the number in row 14 that matches what you put into B2, and then it's pulling the accumulated present value of the equity excess returns. And you can see we put in 2, the accumulated present value of the equity excess returns is 1,451, and that's what it's using the horizontal lookup to find. So I know this is a pretty quick overview of this spreadsheet. You're going to have to dig in to learn a little bit more about it, but after you put in the ticker, the length of the excess returns, the cost of equity, the ROE, and the dividend payout ratio, you're going to at least have a good starting model, a starting point for a model of the excess returns. Hope this helps.